Good evening, TheoTrade. This is Corey Rosenblumen. You're watching the Theo Nightly video for the 13th of August here in 2020. What you're looking at is not a jarbled mess. It is the sector spiders. And these are things within sector rotation that shows us which sectors, and that's mainly, I know, we've been focusing on technology, which has driven the Nasdaq up there. And just in technology, it's been the monsters of tech. Now, I know Amazon actually is part of the retail sector, which is XLY. So in tonight's video, I do want to take a look at the major sectors that are moving the market beyond, well, obviously part of, but beyond the top names of technology. So we're looking at these three strong sectors or offensive sectors, and that's things that do well when the economy is in recovery. Those are financials, technology XLK, XLY is retail. These are both called offensive or risk on. So if these are doing really well, and they are, that is indicative or suggestive that the market is strong. And I know it may not seem this way, but it suggests the economy itself is strong too. We'll put that on the back burner for the moment. Beneath that is the three mid-cycle sectors, and they're just kind of neutral. I is industrials, B is materials, and E, which I consider to be off on its own island, is energy. And beneath these are the defensive sectors or risk off, protective sectors. There's where things are interesting. So if you remember in prior videos, I've been highlighting your attention towards Campbell's Soup. And we take a look at McCormick Spice, right? Random little stocks that are really boring. Boring, but efficient. So these are the names in here. And the logic is even in a pandemic, even in a recession or whatever you would like to call the global type of economy, you still have to brush your teeth. You still have to eat. You still have to drink, and you still have to clean your house. Clorox and little companies like that, Johnson & Johnson, just to name a few. And those are stocks that are stealthily getting stronger, and they still are. So they'll be within this defensive sector name. V is healthcare, which is up at the highs as well. And U is utilities, which act a little bit like the bond market. And the main point with this is, number one, compare how the pandemic sell-off, all the sectors were hit. Some not as bad as others. And the other thing to compare is when you're looking at comparative charts, which is what this is, it's an easy way to see the market, not as the S&P 500 or the Nasdaq, but within the 9 sectors within it. And that just gives us clues about which stocks to be looking at and which sectors are driving the market or which are underperforming it. So because they're all scaled similarly, we can take a look at the top right, middle, or bottom of the charts and just compare. So for example, things in the middle, which means they haven't done that well. They're not at the lows, the pandemic lows, but they're about halfway recovered. That would include financials, which is under pressure, would also include energy, which is sort of like crude oil, and would include utilities, which tends to behave like the bond market. So those are the three sectors that are in the middle, which are relatively weak when compared to the strongest sectors, which that's, of course, going to be technology, XLK, retail or discretionary, which is XLY, but the stealthy little thing that I, again, keep bringing your attention to is P, which is staples, maybe even healthcare, although I don't really do a whole lot of trading in the healthcare sector. Staples, that's just consistent, slow growth, but like the tortoise and the hare, sort of. You have the tortoise that it's slow and steady versus the hare that's just fast, but has trouble of breaking down. It's just more volatile. Depends on how you like to trade or manage your positions. So all we're saying is the strength remains in technology and retail. And right there with staples, which is part of retail, you still have to buy these products that you use. It's still a retail type of sector, but it's more defensive. And that includes beverages and other products like that, food stocks, not restaurant stocks, but food itself. Again, Campbell's Soup, those sort of things. Hormel Foods. So if you're looking to trade in something strong getting stronger, these are where the attention will be. And again, that's XLK technology. Just jump inside some of the names, and just by looking at the percent change of today's market, when it was relatively flat, Our strongest names were Apple, Netflix. We had some others that included Google and some others. So that was some of the names there. Now, of course, outside technology, we have Salesforce, Nike, which is retail, Adobe, Merck, Triple M, UPS, FedEx, and the others. Just taking a look at this, that's all. In the broader market, we'll pull the perspective up. Can't go a video without saying how close the S&P is, or at least the S&P futures. We do want to take a look at the SPX. That's a little bit of a more appropriate way to look at the broader market. And that is 3393 and fell a few, maybe 10 points or 15 or so points shy of that today. And our weekly expected moves are still in play. So this uptrend continues. Strong stocks do get stronger, but not before they pull back. So that's what the push-pull effect is, or the frustration, if you will, with the market. When it goes up, it doesn't go straight up, not usually at least. It tends to what we call wiggle and squiggle, or retrace. So again, for strong stocks getting stronger, like Apple, it's nice to have a risk-controlled entry into it. Same for Salesforce.com. And these risk-controlled entries are pullbacks, retracements, sell swings. It can be 2 days, it can be 3 days down, it can be 3-4 days down, it can be 1 or 2 days down, but at least give us a couple, please give us a couple of days. That way we can try to get into long positions or spreads. And that's joining an uptrend. What we do not want to do as swing traders is try to get into a strong stock when it is well above the moving averages or the trend lines. And that's mainly where it's 1, 2, 3, 4, 5, 6, 7 days in a row to the upside. That's not a spot where you want to start getting long. It might feel comfortable. I mean, you're definitely chasing the market, but it's not really a good risk-reward opportunity. Same thing here. 1, 2, 3, 4, 5, 6. Boom. If you're entering a position to a trending stock, Nike, for example, or Netflix, or just any number of stocks we recommend, and the things that I scan for, making new 52-week highs, do so on pullbacks or retracements or bull flags. Because if you don't, you stand the risk of getting long right before a drop. And that's a strategy you can do, but it's quite aggressive. That is buying puts or selling short shares when a market is extended 1, 2, 3, 4 days above the average. So there's no one way to play these stocks. I do prefer buying the pullbacks because it gives you a little more room to go. But other traders, in terms of the slow grind to the upside, as opposed to getting it perfect and getting these 1, 2, 3 days that the market pulls back, either perspective is fine. What we do not want to do is be over aggressive and over bullish when the market is extended from the averages and get long and risk a snapback. But we also don't want to say, well, that's the market's topped, we're going to go ahead and fade and get short after a 1, 2, 3, 4, 5 day down move. So just think in terms of context, pullbacks, retracements, sectors, which include financials, things that are strong, which is technology, the broader sectors, and retail discretionary, and beneath that is staples. So all these things are in play. All these things are compared to where they were at the earlier peak, so well above it, or right back at it. As always, control your risk on any position, short-term or intraday. This is Corey Rosenblum with tonight's Theo video for August 13th, 2020.